Hello, everyone. In our previous session, we talked about target pricing, and we had sort of an introduction to the concept of differential analysis, where we look at different pricing or cost scenarios, and we make short-term business decisions based on the relevant costs and revenues, along with a discussion of what relevant costs and revenues are. So we talked about an example with target pricing where we had revenue at market price minus our desired profit to arrive at target full product cost. Today I'm going to really briefly talk about another costing methodology called cost plus pricing, and then I'm going to go through two examples of special order proposals in two different companies in our sample problems. To look at whether we should accept or reject potential special orders. So under cost plus pricing, which is normally something you do when you have price setters, if you recall from the last session, you take the full cost of the product, you add on the desired profit to arrive at your cost plus price. Okay, so in this case, you can set your own price. Therefore, you decide on that price based on your desired profit. In the previous example, when we looked at the target pricing, we were not able to set our own price. We had to accept whatever price was taken, or we would have to take whatever price as a price taker, whatever price we could get on the market, subtract out our desired profit, and that would give us a target cost that we had to achieve or meet in order to achieve our desired profit. Okay, so coming at things from the opposite direction, depending on whether our goods allow us to set the price or force us to take the market price. Okay. All right, so an example of cost plus pricing. In our technology company, they have a desired profit of 10% of their average assets. And so they looked at their current level of sales. And then they had, all right, here's our costs for variable costs, including direct materials, labor, and variable overhead. They added in their fixed costs to arrive at a full product cost for 2,400 tablets, which each cost $307.50 to produce. So their total full product cost was $964,000. Their desired profit was 10% of $2.5 million in average assets. So their minimum return was 10% on those assets. Meaning they wanted to make $250,000. So their target revenue then, in order to achieve that profit, was $1,214,000 in total, which they divided out based on the number of units to arrive at $506 per unit. Okay. All right, so the decision rule for pricing is if a company is a price taker for the product, they need to use a target pricing approach. If they're a price setter, then they would typically use a cost plus pricing approach. So the next thing we're going to talk about here after discussing that other cost plus method is special pricing decisions. So let's say we have a customer that comes along and they want to order something from us at a reduced special price. So some of the things we have to consider is, do we have extra capacity available to fill the order, or will we have to cut back on other orders that might be at regular price? Will the reduced sales price be high enough to still cover our additional costs for filling that order? And will it affect our regular sales in the long run? So and then ultimately, right, like if we have a minimum percentage return of some sort, will we still be achieving our minimum percentage return on assets if there are, say, additional assets that have to be acquired in order to cover this order? So here we've got two different income statement formats for Smart Touch Learning: the traditional format with net sales revenue less cost of goods sold to get to gross profit, minus the selling and administrative prices, getting to $236,000 in operating income. So this is the same dollar amount we had on our previous budget that was shown. Here it is in a contribution margin format. Same numbers, only we're breaking out the cost of goods sold and the selling and administrative between which parts are variable, in other words, which parts change based on the number of units, and which parts are fixed. So looking on the contribution margin format, we see that we have manufacturing costs that are variable and selling and administrative costs that are variable up here. When we subtract those from the same exact revenue, we get 462,000 in contribution margin. Then when we subtract out the fixed costs, we arrive at the same income. So these expenses in this column here are exactly the same in total as the ones over here in the traditional format. They're just being presented differently by separating all the and grouping all the variable costs versus all the fixed costs. So similar to how we did it in our contribution margin income statements earlier in the semester. Okay. Now, so here they're going to look at, if you remember, we talked about incremental revenues and incremental costs associated with different scenarios, right? So they said, hey, how much more revenue will we achieve if we take a special pricing order here? So they had $275 was the special price, which if you remember back to our earlier slides here, they were let's see, the revenues they were getting were, all right, I can't find it, but somewhere higher than that, right? So this is a discounted price that they're getting here on this at $275. So producing 250 additional tablets at $275 would get us an increase in profits of $68,750. Now, if there was going to be a loss of any kind of other sales as a result of accepting this special pricing order, we would net those other reductions in revenue against this, okay? So you have to consider if there are increases and decreases in revenue. Their additional manufacturing costs are $245 per tablet. So they have an expected increase in operating income here of $7,500 as a result of this order. So this is just the difference, what would change, not what the total revenues were, okay? All right, so we would accept a special pricing order if the if the increase in revenues is more than the expected increase in costs, right? So in other words, if the net income that would result, the change in net income is positive, we would accept the special order. If the change in net income was negative, it would result in less overall net income, we would reject the special pricing order, okay? All right. So let's take a look then at problem number 4 in our sample problems. So we did 1 through 3 already. And I'm going to move this over here and grab an Excel sheet that we can use to calculate here. There we go. All right. I'm going to open 2. I don't need 2. I just need 1. Thank you. There we go. Okay. So we have a baseball Hall of Fame in Cooperstown, New York, and they have approached collector cards with a special order request. The Hall of Fame wants to purchase 56,000 baseball card packs. And they want to pay 38 cents per pack. Okay, so total of $21,280, okay? Which is the 38 cents times 56,000 gets us that 21,280. All right, let me just format this really quick here. So everything is readable. Okay. So, and our cost per pack, okay, is 58 cents per pack. Okay. And that includes But let's break this down here, right? So we've got direct materials, direct labor, variable overhead. So total variable costs are the 11 cents, 9 cents, and 8 cents. Or 28 cents per pack, okay? All right, that's important to keep in mind. And then um, they have a fixed overhead per pack that they're charging out of 30 cents per pack there. Okay, so um, that's something we want to look at though, because right, are we actually paying like which one of these costs do we actually care about when we are considering whether we should take this order or not, right? So when they talked about this in the slides, they just mentioned here um, increase in revenues exceeds the expected increase in variable and fixed costs. So the question then becomes, will fixed costs increase, right? Because if they will not increase, then we should not pay attention to them, right? If they're not going to change, then so here it says we have enough excess capacity to handle the special order. So what that tells us is that we don't have to do anything extra in terms of equipment or things like that in order to complete this order. So no, they will not. Okay. So because of that, we're just going to totally ignore this right here. And it's, oh, I was hoping for a strike through right there, but we're going to ignore this altogether. And really what we care about is this 28 cents. So when we look at which ones are relevant, it's only the ones that are going to change. So our expected increase in revenues is the 21,280. Our variable manufacturing cost for these cards, it's 56,000 cards at 28 cents per pack. Okay, so that would get us total costs of 15,680. And that's what we would consider here. So we have an expected increase here because our revenues are exceeding the change in costs that we have there. Okay, so and that difference is 21,280 minus the 15,680, which is $5,600. Okay. All right. So from a dollar perspective, to me, it looks like this is a good deal. Okay, so under this condition, we would accept our special sales order for these cards because our fixed costs would not change. Now, let's say that the Hall of Fame wants special hologram baseball cards. They will spend, so we would spend $5,700 to develop the hologram, which would be useless after the special order is completed. So the design of the product has a $5,700 cost for us. That is a one-time cost that would only be related to this particular order. And we consider that a fixed cost because it's not on a per card basis. So I'm going to plug that down here as an increase in fixed manufacturing costs. So now if we look at this, it's $21,280. There's no change in special pricing here, so the price is the same, right? They told us that. And they don't mention anything about a difference in per card manufacturing, just the fixed cost. So I'm going to assume it's the same 28 cents, which would mean the same 15,680 in increased costs that we calculated before. Actually, I should put a minus on there. So now, though, we have a little different decision here because let's look at this. When we subtract out that additional cost that's associated with this, um, we end up in the negatives, right? And our costs then end up being um, 21,380 total. So $100 more than what we would have in increased revenues. So that would be a decrease in operating income for us if we did this. Oops, what did I do here? I forgot a negative sign. That's what, there we go. So we end up coming out worse if we do this special order. So in this case, we would reject the special sales order because we would not be benefiting from that. Okay. All right. So in this next problem here that we've got another potential special pricing situation here. So I'm just going to delete all this out of here. And so we've got Newtown sunglasses, and we sell glasses for $154 per pair. And so here are our costs per pair. Oops, I should say per pair. All right, and then, so we've got direct materials, direct labor, variable manufacturing overhead. And then we've also got variable selling, general and administrative for $3 here. And then our fixed overhead, which they're saying is $20 per pair, is actually a total of $2,050,000 in fixed costs. Divided by 102,500 pairs, okay? So that's what they're assuming there for their fixed overhead distribution. So the total for the variable costs then gives us $53 in variable costs per pair. So our contribution margin here then is the revenue per pair minus the actually here I'm gonna link this in case we want to manipulate those at all. So E2 minus E8. So that's our contribution margin per pair. Okay. All right. So Newtown has enough idle capacity to accept a one-time only special order from Watershades for 17,000 pairs of sunglasses. And the price will be $80 revenue per pair. Okay, and I don't know why I keep typing paid, but whatever. There we go. So that would get us a contribution. Let's see, if we had revenue per pair of $80, let's see. Let me look here. Anything else we need there? No, I think we got everything. Okay, so how would accepting the order affect Newtown's operating income? So in addition to the special order's effect on profits, what other long-term factors should they consider when deciding to accept the order? Okay, so in terms of revenue, we're just going to take our 17,000 pairs and multiply it times the $80 per pair, which would give us $1,360,000 in incremental revenue, okay, or additional expected revenue. All right, now in terms of expenses that would change, it's going to be the, let's see here, what do they got here? So $53, it looks like. Oh, yep. And then, okay, sorry. So this right here, this portion right here is our additional manufacturing costs, but because this is a special order, in theory, we wouldn't have any variable selling expense on this. So let me look at this. Do I have the right 30? Oh, 15. Okay, hold on. There we go. So $63. And then we're going to ignore our variable selling expenses because we don't need to sell anything here. Unlike our other sales, we would not have any additional sales expense for this. So Newtown will not incur any variable sales expenses for this order. So it's actually just going to be $60 prepare and expenses. Okay. Go 1,020,000. And so difference between there would be $340,000 in incremental revenue because our fixed costs are not going to change. So we expect an increase in our operating income based of that. Oops, I forgot to put the minus sign again there. There we go. In terms of that amount. So now they're asking us, in addition to the special orders effects on profits, what other qualitative factors should we think about here? Well, probably let's see, how will Newton's competitors react? We definitely want to think about that. So if there's a company that we're selling it to and we're giving them a better price than their competitor and they're both our customers, they're going to be very unhappy with that. Will lowering the sale price tarnish our image as a high quality brand? Yes, that's an important consideration also if we start lowballing stuff. Will our other customers find out about the lower sale price? Potentially, yeah, that's an issue too. So will our competitors lower their prices, causing a pricing war? Will we have other sales issues with our customers and whatnot? So all of those are issues. All right, another question they've got here. Newtown's marketing manager, Peter Kyler, argues against accepting the special order because the offer price of $80 is less than our $83 total cost to make the sunglasses. So our total cost right here is including fixed manufacturing overhead, right? So is that manager looking at things the right way here? Okay. So we should actually only be comparing the incremental costs. Revenues, let's see. So the revenues we receive against the differential costs that we will incur to fill the order. Yep, that one. And then costs that we will incur whether or not we fill the order are irrelevant. So if we have fixed costs, they are irrelevant to our decision here, this additional $20, because they will not affect the decision. Likewise, we eliminated the variable selling expenses because we were not incurring them when the customer came to us to ask for this order. So because of this, it's not a correct comparison to compare the $83 full cost because let's see, making it is incorrect. Yeah. Because we only want to consider the things that increase or decrease. So additional revenues and additional costs we would incur to fill the special order are relevant if we accept the watershed special order. We will only incur how much of additional cost? I think we said 60 in variable costs per pair, which is less than the $80 we would get for revenues. Therefore, we should accept the special order in order to increase our company's operating income. All right, I'm going to wrap up on that, and we will start out in our next session talking about the next type of short-term decision that we would look at.